Greetings, everyone. It's Employment Day, and so as we have since the beginning of the coronavirus, we like to share our point of view on the macroeconomic backdrop, particularly scenarios that we're not hearing out there, but which we believe are coming together in the data that we're seeing. So it's a really good exercise for us. Part of it is seeking clues about deflation and innovation. So from an innovation point of view, that's a very big consideration. We do follow the economy. I've followed it since the late 70s very, very closely when I started in economics. And I do think it makes sense to have a good understanding of the macroeconomic backdrop. Certainly as a portfolio manager, I find it useful. So as usual, we'll start with fiscal policy and monetary policy. Then we'll talk through some economic statistics and the puzzle that is in the economy, the puzzle pieces we're trying to put together. And then we'll turn to the markets, including crypto, at the end. On fiscal policy, it does look like a bipartisan package for the infrastructure bill is brewing here, which is good news. And it also seems as though 130 or roughly 130 nations are agreeing, including our own, to a global tax policy such that any corporation around the world would have to pay a minimum of 15% in taxes. Now, I'm sure we don't know all of the ramifications, and I do know that Ireland and Hungary are holding back, and so it's not done until it's done. But I do believe that it is taking the subject of taxes a little bit away from what we thought was going to be a jump in the corporate tax rate to 28% from 21. Maybe it goes to 25, just to put some finishing touches on corporate taxes. But capital gains tax rates and income tax rates, the probabilities there, we think, are going down of increases. Now, of course, we could be wrong, and the policies change. The policy environment is very fluid. But the closer we get to the midterm elections, the lower the probability. So I'm liking the fact that we're in the second half of the year now, and the tax talk is more about this minimum corporate tax on a global basis. So that's good news. On monetary policy, well, we had the FOMC meeting this month. And the tone coming out of it, the markets at least thought, was hawkish, meaning the proclivity to tighten monetary policy was increasing. And given the economy that we have, actually, that should be the case. We are in quantitative easing mode, and the economy's flying, and we're in the sharpest rebound from any recession, according to the National Bureau of Economic Research, the sharpest rebound from the shortest recession and the sharpest recession in post-World War II history. So it would make sense. We're out of the woods for monetary policy to normalize. And in a stealth-like way, it might be doing just that. I was surprised to see that the rate of growth in M2 has dropped from 27% in February to 13.8%. And it's a pretty sharp fall. So the rate of money growth is decelerating quite rapidly. And for those who are monetarists, I am not, but for those who are monetarists, that's going to be a source of relief from an inflation point of view. Now, it is still higher than the 6 to 7% growth rates in place before the coronavirus, so twice as high, as a matter of fact. But we're looking for clues as to why the bond market, against all odds, continues to rally. And that's both the Treasury and the corporate. And the reflection of that is corporate yields are very low relative to Treasury yields if we look at them in the context of history. And as you know, we have a bias based on our research on innovation to focus on deflation, because technologically enabled innovation is inherently deflationary. So we have that bias. But I will tell you, with the CPI reports that we have gotten, PPI as well, much higher than expected, I would have expected the bond market to continue to sell off and interest rates, therefore, to go up. Instead, since the end of March, the 10-year Treasury bond yield has dropped from 1.74 to 1.43, no matter how strong the economic data have been, how high the inflation numbers have been. And so the bond market is sniffing something out, I believe. Now, many will say, well, it's just quantitative easing. And I think quantitative easing was true at the beginning of this year and through March, when we went from 0.9 to 1.74. So nothing's changed on that score. But the bond market is sniffing out something here. Is it the deflation associated with innovation? Well, as much as we would like to think, all of the innovation platforms around which we have focused our research, so DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technology, the base at which they're operating in absolute dollar terms is quite low to the rest of the economy. Nonetheless, from a competitive point of view, innovation is going to cause some legacy companies to cut prices in order to stay relevant. So it could be. And I'd like to think that is the case. That's a very good source of deflation. What it means is, as prices come down, demand picks up as more and more sectors participate in the new technologies. The bond market could be rallying because of what I just mentioned about money growth. I don't think many economists have observed, I haven't seen it at least, that the money growth rate has been cut in half from that 27% to 13.8%. Maybe the bond market is focused on that. The Fed itself is focused on core PCE. That's the deflator, the inflation rate for consumption. And it has moved up to 3.4%. And I would say it could go to 5%. I thought maybe it would top out at 4%, but there has been a head of steam at work here, and we're seeing rents go up dramatically, and that's influenced by house prices going up, at least how it's measured in the inflation gauges. We've seen oil prices, against our expectations, shoot past $70. Now, I believe the last peak in oil prices was around 77, if I'm not mistaken. And if we hit a new high, then I think we'll be back in a period much like 06. In 06, oil prices went from roughly $60 toward the end of that year to where they ultimately topped out, I think, at 100, if I'm not mistaken, it was 100. I forget the absolute high. So the peak in oil prices, I think, was $140 in early 2008. And each peak after that has been lower. If oil prices break above that 77, we will see a higher peak for the first time, which is not in keeping with what we thought at all. One of the reasons is, of course, OPEC, and they have about 5 million barrels, spare barrels they could produce per day. They're not. They want to keep the oil price high enough so they can fund their budgets. But at some point here, they may end up killing demand. when they start seeing demand destruction because of pricing, I do think they'll start producing. And as you know, longer term, the combination of electric and autonomous electric vehicles, we think, is going to drive oil prices down. As I've said, now this is my point of view. We haven't done the research to get us here yet, but I think we could go down, back down to where oil prices landed after the cartel took over in the early 70s. And they went from, I think, $3 a barrel or $4 to $12 a barrel. Wouldn't be surprised ultimately to see us back there, especially as electric vehicles continue to take off, and they are starting to take significant share. And I think subsidies in China and elsewhere are going to accelerate the shift towards electric vehicles. So, and also helping it are the number of traditional automakers who are now have pulled out all the stops, and they are designing and producing electric vehicles because they're better cars, they're better for the environment, they're better performing. It makes a lot of sense. And most important, from the consumer's point of view, from an adoption point of view, is their prices will continue to fall. So again, the deflationary undertow there. So I'll get back to the bond puzzle here as we go through the economy and market. So let's do the economy. Employment report. Non-farm payroll employment was 850,000, an increase. The expectation was 720,000. That's good. The biggest increases were in leisure, hospitality, as well as state and local governments. Those were the two biggest sources of employment growth. But there were a few weak spots, again, that I don't think many commentators have picked up on. The unemployment rate did tick up from 5.8% to 5.9%. What they did not pick up is that household employment, which is not the same as non-farm payroll employment. In fact, the survey size for household is much larger, and it includes a disproportionate number of small businesses, small and medium businesses, unlike non-farm payroll. It actually fell 17,000. So it's not consistent and with the headline news, and it often is a leading indicator of changes because small businesses tend to react very quickly to less than good news. The other number that I didn't see many economists feature is the work week. The average work week dropped by 0.3%. The manufacturing work week dropped by 0.5%. Overtime dropped by 0.3%. Now, as you know, we've been saying that businesses have been scrambling to catch up with consumer demand since the beginning of the coronavirus crisis. The stimulus checks made a big difference, took the saving rate up to the mid-30s, never seen that before. And of course, consumers started spending on goods. So what's interesting about this dichotomy is if we're right and businesses have been scrambling, and inventories relative to sales are still at record low levels. What is this all about? Is there just something funky about one month's data? 1 month does not a trend make. That is absolutely true. Perhaps, but I was surprised to see that. Construction employment fell for the third consecutive month. This, I believe, is because of shortages of materials. We've heard of some builders taking the summer off because they just can't get all of the materials they need to complete homes. And unexpected was auto sales. The unexpected part is that they came in at 15.4 million units. The expectation was more than a million higher, so 16.5, and the previous month was 17 million. Now, here again, we're hearing a lot about shortages. There are chip shortages, and so all the automakers are saying that they're having trouble getting all the chips they need to build their cars. And of course, we know the used car market has been on fire as well for that reason. So maybe that's all this is. Or I'm beginning to think, is this shift towards electric vehicles moving into higher gear? And just to give you a sense, electric vehicle sales last year were 2.2 million units globally, including China. Now, that was out of a total somewhere in the 80 to 85 million range. So 2.5–3% of total sales. So there's a long way to go if we're going to get to our expectation of 40 million units in 2025. And we should see that acceleration occur now as prices continue to fall and as more electric vehicles are put on the market from more companies. So what if that is happening? We're going to be listening carefully to the auto earning reports, and I think there will be a lot of obfuscation, not necessarily intentional, but we have the chip shortage, that's real, and we have the shift towards electric, that too is real, and maybe we need the shortages to diminish before we understand what's really going on here. But I do look at moments of crisis, and the last year certainly was that, for big changes. And while we've been surprised to see auto sales pick up so much, makes sense in that most people who have taken mass transit historically decided they're not going to do that. They're either going to continue to work at home or they'll buy another car. So the sales have been very strong for that reason. But again, we're going to normalize here and really see what's going on. So we'll be paying attention during the next 6 months. I also wanted to talk about this notion that for the past year, or while we were basically locked in our homes, the spending that we did was disproportionately on goods. Durables and non-durables. And goods are only 1/3 of consumption. Services make up the rest. So we have expected, as vaccinations proliferate, that the shift in spending would be at the margin from goods to services. And to put a number on how that number worked out during the crisis, we shifted from roughly 33% spent on goods to 41%. And when you talk about the largest sector of the U.S. economy, that is a huge difference, huge difference. Now the consumer, my guess, is loaded up with goods and may be where a lot of inventories are. And the reason I say that is, if you look at durables consumption, it peaked on a year-over-year basis at roughly 75% growth. Think about that, nearly doubling our spending on durable goods. I believe some of them are going to be in inventory, and because of that, they won't be purchased in the future. So now we're seeing the first signs of this. In May, the latest number we have, real consumption dropped 0.4%. When you break it out between goods and services, durables consumption dropped 4.3%. Think of that, 4.3%. Annualizing that, that's a nearly 50% drop at an annual rate. That's a huge, huge change. non-durables down 0.5%, and services up, but up only 0.4%. So that was interesting. We also learned that in May, disposable personal income dropped 2% month to month, again, mostly because of stimulus checks having been sent out, and that's the base against which we're comparing May. And the saving rate dropped to 12.4%. Now, 12.4% is still high by historical standards. Right before the coronavirus, we were at 8%. At the peak, we were in the mid-30s. So we've come a long way, but we could go further down in terms of pulling savings down in order to fund purchases. So we'll see what happens there. Another curious thing we learned was retail inventory. Retail inventory in May. Now, retail is mostly goods. Retail inventory fell 0.8%. Now, and that's after a drop of 1.6% the previous month, while industrial production is going up 0.8%. So that's where kind of the light bulb went on for me. Could it be that the inventories are not going to be at retail stores? They have backed up into the consumers' homes. And that's why consumption might disappoint going forward, disappoint the retailers going forward. Just to talk about a few other disconnects here. Against, I think, the consensus expectation, the consensus short on in terms of currencies was on the dollar at the beginning of this year. And the dollar is not going down. And that's also consistent with the bond yields coming down, surprisingly. Now, it is true that our bonds are offering, even at this low rate, 1.4%, 1.43%. They're offering more than the negative yields elsewhere in the world, Germany and Japan. But that's been true. That's been true for a very long time. So at the margin, that we do not believe has made the difference. What could be making the difference in terms of the dollar going up is this notion that the terms of trade are not going to turn as much against the United States in the form of higher corporate tax rates. And in fact, this 15% minimum tax will hit everyone in the world. Now, it will hit disproportionately some of the very profitable tech companies who have been able to manage taxes globally to very low levels. But that, again, it's true for everyone. So at the margin, maybe that is why the dollar's going up. We've also seen some quite deflationary signals, outright cyclical deflation, which got us thinking about inventory corrections. Lumber prices have been cut by more than half now. And maybe that was lumber that do-it-yourselfers were storing up, seeing the lumber shortage coming, and they're just not in there buying now. That's pretty interesting. In China, pork prices have dropped precipitously. Now, we may not pay too much attention to that price, but that might be the most important price in China in terms of keeping consumers happy. It's a big part of their diet, and the government watches it very carefully. So that's interesting. Copper prices are still down in the 10 to 15% range. So there are some signals out there that perhaps inventories are somewhere in the system, and we're seeing a cyclical unwind here. Oil, as I mentioned earlier, is the outlier. We'll see what happens with the OPEC meeting. As of this recording, I guess they had not come together on any agreement. I know the UAE wants its base adjusted upward before agreeing to a 400,000 barrel increase in supply. So we've been wrong on oil prices, but I will say the higher the price goes, the more demand destruction there will be, because there will be an even bigger incentive to go electric moving forward. And now onto the markets. As we've said all year long, this bull market has strengthened. It has deflected all kinds of bad news. The doubling in interest rates in the first quarter, the Archegos leverage blow up in the ecosystem, which many thought could cause systemic problems. We've been through tax hike discussions, which sounded pretty onerous in terms of their impact on capital. And we've seen a big correction. We certainly were right in the middle of it in valuations as those interest rates went up in the higher valuation side of the market, particularly if one is looking at valuations as of this year on this year's earnings. So we're very happy at the way the market has performed. It's up double digits, and we've seen now a shift, a rotation back from value as some of these prices have started to unwind, the commodity prices in particular, towards growth. But I think we're going to see toggling back and forth until some of the confusion that I'm discussing here dissipates. What's clear is profit growth right now has been or is explosive. I think for the second quarter, at an annual rate, the S&P is annualizing earnings at $220. So that's roughly 19, 20 times, really effectively trailing earnings. And if we think earnings are going up, and we do, then the multiple looking forward is moving down into the mid to upper teens. That is good valuation support given the level of interest rates. But if we're right, and there is an inventory cycle brewing here, and there are wage pressures brewing. I mean, we hear headlines of all the labor shortages, and in fact, the JOLTS index, so that's the job openings index, it shot up to an all-time high, another all-time high. 9.3 million jobs are just waiting to be filled. There is either a skill set mismatch or the wages are too low. And so we are seeing a lot of industries increasing wages to try and attract labor. Now, we do have many people still out on their stimulus checks until the end of September. That's in the lower wage categories. So that supply will come back in, and JOLTS, that number, 9.3, will go down. So that could take an edge off of the inflationary ramifications and the margin pressures associated with wages. And I do believe if we do go through this inventory cycle and we see some profit pressure caused by costs, especially wages, that the market will become more discerning. I think that this shift towards growth will gain more momentum if this happens, because cyclical earnings growth will provide less competition. I do believe that what's going on in the bond market, this big surprise, it's really the flip side of the surprise that I witnessed when I first started in the business in the late 70s. I remember I used to deliver, and everything was by hand. There were no computers. In the late 70s, I used to deliver the inflation reading. It was the second Friday of every month. And my boss at the time just didn't believe the inflation numbers, but the bond market was getting it right. He just didn't believe that the numbers were right and thought they would correct and that the interest rates would come back down. I think we might be on the flip of that right now. The bond market is signaling there are more deflationary pressures brewing out there, we believe, than most investors appreciate. I've just mentioned the good deflation associated with innovation, but the other side of that is creative destruction and the deflation that will hit companies who have leveraged up to buy back shares, manufacture earnings growth, have not invested enough in getting ready for the new world. And believe me, every sector is going to be transformed. And so they will face significant pricing pressure as their products really go obsolete eventually. And then the cyclical deflation. Well, the bond market seems to say this is what's happening. And if that is true, because most people don't believe 1.5% is a real interest rate, they've been normalizing, I think, in terms of the way multiples have worked out in the market. They've been pricing or valuing stocks as though the normalized interest rate is somewhere around 4%. What if it's not? What if it is half of that? That would be huge for secular growth companies, especially because there's going to be so much confusion. You have all of this innovation, which is going to be very exciting, and then you're going to have all of this destruction, which is going to be pretty demoralizing. It's going to be so important to get on the right side of change. So, part of our mission and value is to educate. We know robots are coming to satisfy or to take care of wage inflation problems. Today in our brainstorm, we're talking about robot picking strawberries. And big debate about that. Are we ready for it? Are we ready for it? And I think we believe we're ready for it. On the oil price side, the antidote to that, electric vehicles at an accelerated rate, almost a self-fulfilling prophecy if the oil price keeps going up. And just a little note for Tesla fans here. It was interesting to see in their sales, which I think were up 84% year over year, certainly taking share from the old world. If you looked at their press release, there was a very interesting picture. It was their semi-truck. Now, this press release had nothing to do with semi-trucks, and certainly not electric semi-trucks. And yet there it was. No explanation, just that there it was. And I do think it's because of some of the Too Simple and the Plus and the Aurora deals that are coming out. And Tesla's basically there just reminding everybody that, these companies think they have an autonomous truck business. Just you wait. And I was happy to see that, actually. And then finally, I just want to, on the crypto side, address a question that we've been getting quite frequently. You can tell how convinced we are that deflation is the higher probability. And we know that's way out of consensus, and that's where we like to be. But many wonder how we could be positive at all about Bitcoin if we're not worried about inflation. Well, I think 08, 09 is a very good reason why. Why did 08, 09 almost melt the financial world down? It did so because of counterparty risk. And what we've just seen in the crypto market is really interesting. It's been cut in half, 2 trillion to 1 trillion, the ecosystem, in the last few months, just cut in half. Can you imagine what would happen if our equity prices, bond prices were cut in half in the span of a few months with all the leverage out there? I think we'd be in a counterparty risk problem again, a big mess, maybe not as big of a mess as we were in 08, 09, because there have been some changes. But I do not believe that our financial world would withstand a 50% drop. as easily as the DeFi world has. DeFi, while a lot of people who were leveraged 100 times elsewhere in the world were wiped out, I think, I'm going to get this number wrong, it was either 86,000 or 860,000 accounts wiped out. DeFi didn't skip a beat. I don't think we could say that for the traditional financial world. And I do think that's why the shift towards DeFi, helped now by central banks moving into stable coins and legitimizing digital currencies, even though that's very different from Bitcoin. I do think we're going to accelerate further and faster into the DeFi world. And that too is very exciting. And as you know, if Bitcoin's price on a trend basis, remember, we're still a triple since last September. We may have been cut in half, but we were still a triple since last. And if the price continues to move up, what does that mean? That means increased purchasing power, which is what deflation is. So very consistent with our view of the world. And with that, I'd like to wish everyone a very happy 4th of July weekend. We're a very lucky country, and I'm looking forward to the next 6 months and to lots more innovation in the pipeline and learning about it and sharing it with you. So thanks very much.